Hello and welcome to today's webinar. Are you looking to raise funding to help grow your business? Thank you for joining this session today, where we will discuss the finance options and opportunities available to local businesses and advise on how to maximise the chances of successfully raising the funding required. We'd love to hear from you during today's presentations. If you have a question for our speakers, please feel free to send it through the Q&A tab at the top right of your screen. This can be submitted anonymously if you would prefer to do so. We'll be answering questions at the end of the session, but if we don't get to your question during today's webinar, we will be sure to follow up afterwards. So I'd now like to kick things off by welcoming Paul Hepburn from Jerroms Corporate Finance. Paul, over to you.
Hi everyone, thanks Sharon. Very briefly, what we're going to cover off this morning is two parts to the session. The first will be delivered by my colleague Tony Seaton, which is all to do with a business being ready and prepared for investment, and then Tony will hand back to me and I'll cover off the funding options, typically what types of finance are available, what they're looking for, how best to approach them, and the kind of things to watch out for in that process. So without further ado, Tony, let me hand over to you.
Thanks so much, Paul. Name's Tony Seaton. I'm based in the Bromsgrove office of Jerroms. I serve Worcestershire and the Black Country in particular, but the whole West Midlands as the whole of Jerroms does. So very much you speak to either Paul or myself if you have any queries related after today. The next slide. So what we're going to try and do is look at different ways, and depending on what stage your company is at, what you need to be doing to make sure if you want to receive investment. The first stage is the startups or the early stage businesses. Have you got a few items to go through? Have you got a company? Is it incorporated? Or are you just still got an idea and thinking about it? Do you need to be incorporated, or can you still be a sole trader? Having to think about that. Market demand for the products assessed. A lot of people have great ideas. We see lots of them, but will it actually sell? And not only will it be sell to somebody, will they actually pay the price you want to see? We actually see a lot of products where they say, yes, it's a great product, we'd love to use it, but we'd pay £10 for it, and you're trying to sell it at £50. It's probably not it's a non-starter. So doing some market research, probably just with your friends and families, that sort of thing, make sure it's critical. Your personal investment and credit rating. Have you got some money to invest? Certainly for the early days, it'll have to be yourself, your friends, family, those sort of people are putting the money in. And have a look at your credit rating. Experian now do a free credit rating check. There's other people as well, just to make sure there's nothing lurking in the background that might cause you problems down the line. A lot of these things can be solved, but it's best to know about them beforehand and they can be dealt with. It can be an old mobile phone bill or something you've changed, or something you've moved address and you've lost track of something. So keep an eye on your credit rating. Prototype beta version. Very few investors will actually invest until you've got a prototype, a minimum viable product. The idea is that I've got a great idea have long since gone now for investment. That is the friends and family. Sometimes angels, but more likely they will want to see some prototype, a bit of commercial traction before they will invest any significant amount. Intellectual property, there we mean sort of trademarks, patents, copyrights. Very mixed views you have on those, and lawyers will potentially say one thing, will say, you have to look at, have you actually got something that's really patentable, or is it just something that you want to cover off? Trademarks and copyright, they tend to be more valuable, but certainly if you're in software and those sorts of things, a lot of them can be changed quite easily to get around patents, and it can be a lot of money to actually get them registered. And sometimes you're better off just getting first to the market, get the product out there, and get that market share. By actually registering for a patent, you're actually telling the outside world what you're doing anyway. You disclosed it, so then it gives people the opportunity to work around that problem. So you're probably actually disclosing more by having a patent than not having a patent at times. Have you prepared some financial forecasts? And that's not just a profit and loss account or a cash flow. Those two items are very different, and we'll talk about those again a bit later on. And combined with a balance sheet. So it's making sure it's an integrated forecast so it all comes together. Yesterday I saw one, somebody done a cash flow, they'd done a P&L, but it actually made no sense when you did the balance sheet. It just made it look nonsense. And do you, the management team, have required skills? You don't necessarily have to have a full team, 2-3 people, often plenty in the management team, but know your weaknesses. If you're not good on finance, have an accountant, they can help you. Have somebody else that can help you with other roles, HR, those sort of things. You don't need to have all the skills yourself. Just accept that you haven't got them and then, subcontract people to them. Have you thought about what resources are required, which comes into the required skills of management team? Don't always assume you can do everything yourself. There's only 24 hours in a day. You need to be perhaps out there selling, developing the product. Your more menial things, let other people do them. There's apprentice schemes. There's all sorts of things where you may be able to get somebody to help you out on the early stages of the business. We've seen a lot of businesses certainly talking to universities and getting interns from universities. Great people, very skilled at the moment. They're all desperate for jobs, can help you out. What security can you provide if you want a loan? A lot of loans will ask for security. There's other loans, for example, the government startup loan company, which won't ask for things, but a lot of loans will expect you to provide some sort of security. Then EIS and SEIS, if you're trying to raise equity, those are important tax relief for the investors. SEIS applies for the first 2 years of trading, and then EIS between 7 and 10 years of trading. We'll move on to the next slide. Thanks, Paul. So very similar, really, for if you're established. I mean, established is probably 1 to 2 years old. Have you done your last set of accounts? Have they been filed at Companies House? This year we've had, because of COVID, people have had an exemption to file accounts up to 12 months after the date. There still carries on that exemption, although it's no longer automatic. But good housekeeping, make sure you do get things filed up to date. Have you filed your corporation tax computations? Just because you haven't traded, you haven't done a lot, it doesn't mean you don't have to file computations. You can still get caught out for fines from HMRC for not doing returns, even though you haven't traded. Management accounts. Do you know actually where you are, your position? You've been going for a couple of years. Can you reliably say what your financial position is at any time? So, for example, are you keeping a zero? QuickBooks, Sage, accounting system. Very simple systems these days. Most people can operate them very easily. You don't need to be an accountant to work them, and you can get very accurate management accounts very quickly, no problem. Crown debts are up to date. That's HMRC, particularly VAT, PAYE. People will always want to know that you've got an agreement with them if you are up to date. They are very good at the moment. They're being quite helpful. They understand people have had problems, there's been issues, but mate, don't just go into hide and seek. They will talk to people. I think that's a lot of things about all of the finances. If you do have any problems, speak to somebody. We had one yesterday where a loan company spoke to me and they said the person who had the loan was refusing to speak to them. They'd gone into denial, but they were quite happy to give him a holiday for 6 months on payments. But you do need to speak to people. So checking the credit rating of your company and director is very similar to we mentioned earlier. And have you got your business plan prepared? And that comes, we'll talk about that again a bit more. Gone are the long days of 100-page business plans, 15, 20 pages maximum. We'll talk about those in a bit more. Integrated forecasts, and do they actually start from where your management accounts finish? Can we see, we don't want a gap period where you've got management accounts up to, say, December. We suddenly start the forecast in April, and there's this big hole of 3 months when nobody quite knows what happened. And similar to the early stage, do we have adequate labour and facilities? What were you going to spend your money on? What security, and the tax reliefs again. So very similar to a startup business. Thanks, Paul. So what do you need to do when you do a credible financial forecast? 3 distinct but related statements, and they should be fully integrated, i.e. if you change one thing, it'll automatically flow through. There's a summary sheet at the front which will list out the key figures, normally an annual summary, but if you're and those assumptions you are driven, they will alter everything. So you shouldn't actually have to alter all the detailed workings. It's purely the assumptions page. It should be clear, and any funders can also then use those assumptions pages and run their own sensitivities. So we've got the profit loss account, I'm sure we're all aware, cash flows, balance sheet, and then they are supported by a number of key assumptions and narrative. So that's the business plan or an executive summary you've done, and you need to think about these. These are all one document. So if you change your business plan, how does that impact on your financial forecasts? Often you find that you have a business plan that's been updated, but nobody's changed the forecast, or vice versa. You might suddenly say, we're going to recruit a new sales executive in November, and then you look at the financial forecasts, they don't come in until March the following year. Just make sure, always think about how it all fits together. It doesn't, Excel is what we tend to do most of our forecasts on, but it shouldn't be an exercise in Excel skills. It's making it simple and understandable. Some people overcomplicate things, and it's not that necessary. Funders basically want to see something they can easily understand, easily deal with, run sensitivities, not something where they need to run through 25 tabs of Excel to find out where the data has come from. So keep it simple. It's at the end of the day, it's a forecast. It's not the operation. It's not a detailed operational plan. Thanks, Paul. So before you start your forecast, where are you going to start from? As we mentioned previously, have you got your last accounts completed so they can compare it with previous results? Your management accounts up to date? Are they reliable? We all know a lot of management accounts, you don't necessarily do them with the same degree of accuracy as you do the year-end accounts. But if you're using them for forecast, for example, your stock figures and those sort of things, it's important to understand those. So try to start with the closing figures, and also any existing funding you've got in the business, make sure that's documented. So what requirements have you got to pay money back anyway? So it may be that you have a startup loan. Okay, it's a startup loan is a personal loan, but the company may need to pay you money for you to be able to pay it back. So it's important that's included. The next one, please. So as I said previously, Excel's great. There are some bespoke packages you can buy. The problem with is you can't often understand what the outputs are. You just put in a load of numbers, outcomes and answer, but you can't understand and explain to anybody how it's created those numbers, and we even ourselves, we find those confusing. So relatively simple Excel spreadsheets are probably the easiest way, and everybody's happy with those. And the next. So the key things in your forecast will be your turnover calculation, so it might be the number of units, the number of users if you're a software company. Then if you've got cost of sales, try to link it to the number of units sold. So if you're selling 10 units, make sure your cost of sales costs also link to those same number of units. And then if you alter one of the sales figures, it will automatically alter your cost of sales figures. Marketing, how are you going to do that? Are you going to use Google AdWords, things like that? Can be very expensive. All the overheads, stock calculation, your debtor, creditor, capital expenditure, and a lot of people try and ignore VAT, but it can have a big impact. So don't just assume that VAT is something that comes in and goes out, because it could have an impact on your cash flow. Next. So what do we see when we see a lot of forecasts? What do we often find the problems are? The opening position doesn't agree to anything. These is practice picking up some of the points we discussed earlier. Narrative in business plan doesn't back up the forecasts. Step changes, sometimes year one you're going on at a level, and suddenly year two you find everything doubles. It probably doesn't happen like that. It's much more of a gradual curve. Let's make it more consistent with what's really going to happen. Three statements aren't consistent. The profit and loss account doesn't reflect the cash flow and vice versa. We see a lot of forecasts where people run out of money. They have money at the end of the year, they have money at the beginning of the year, but they forget to look at month 6 in the middle where they've got a run out of money. It's amazing how many times that we've seen. VAT is ignored. Print settings are not set correctly, so if somebody wants to print out your forecast, does it run to 200 pages or does it nicely presented? Too much detail, and also the problem you get with Excel, sometimes you override a formula with an absolute value and then they can find problems that they don't add up. These are all very straightforward things, but they are things we see regularly. Then moving on to the next one. So the business plan, I think the first thing I would say to anybody who's doing a business plan is, first of all, do a flyer, a 1 or 2 page teaser. Just to see if people have ever any interest. if you're going to do a proposition and there's not going to be any interest, why spend 3 weeks trying to do a detailed business plan, which is probably not going to hit the mark? So get that initial document done, assess interest, albeit you have a feel for how the business plan is going to look, and then get a full plan once you've got the interest received. Everybody will have different questions on their business plan. Whatever you put, somebody will ask different. So don't try and answer all questions. You'll find as you go through the process of raising finance that you'll come to see what people are asking for. The next one. So what's in the business plan? Quickly running through. Time's moving on. So an executive summary. So that's a summary of the following sections. So history and background. Where did you come from? Why did you want to do this? What are you doing it? What is your product? How's your supply chain? For example, a lot of people at the moment having trouble getting goods from China. If you're an automotive company at the moment, microchips are a real problem. So can you actually got a solid supply chain? Markets and customers, we stressed that previously. Who's going to buy your product and are they happy to pay at that price? Organisation structure, that's the management team. Who are you? What credentials have you got? Are you credible to do it? Do you know the industry? Do you know the key players? Financial summaries, historical forecasts, so probably 1 or 2 years historic if you've got them, and then 3 years typically forecast by month. And then if you're looking for equity, people will be looking at an exit strategy. So how are they actually going to get the money out when they want to leave? Because a lot of equity players will want to leave after 3 to 5 years. Moving on, I think it's getting, and now back over to Paul.
Thanks, Tony. Okay, so I'm going to run through the types of finance, what they're looking for, how to approach them, things to watch out for, that kind of stuff. So without further ado, let's get into it. There are effectively 3 forms of finance, and have ever been. Now, it's not lost on me that there are 4 on that slide. I've never been good at adding up, but effectively the final one, the 4th one, is a hybrid really of 2 of the others, debt and equity. So I'll get on to the explanation of mezzanine later on, but fundamentally finance tends to fall into the categories of grant, debt or equity. Debt forms any number of different shapes and flavors, and we'll kind of touch on some of those as we get in. But let's get started with grant finance. Clearly the best type of finance because it's typically not repayable. I say typically, there very often are provisions that if you don't do what you are committed to do as part of the grant scheme and a grant agreement, then there may be a danger of clawback. But typically they're not. There's no requirement to service them. As a consequence of that, it won't surprise anybody on this webinar to hear that the demand for grants, always historically and utterly completely dwarfs the supply of them. We ran a grant scheme for staff a couple of years back, and I think the applications for the amount of funding that we had at our disposal was close on 10 times the amount of funding that we had available. So clearly, there's always going to be some people that are disappointed. There is an output requirement quite often in a grant scheme that they'll require they'll have an expectation of certain deliverables, certain things that they're expecting the project to deliver, and as noted there, that could sometimes defy business logic. I mean, it's not lost on me that sometimes businesses are looking for grant support towards capital expenditure, which has a desire to improve efficiency and thereby potentially reduce headcount, and yet the grant schemes can quite often have a requirement for jobs to be created. So sometimes they do defy logic, but they are nonetheless there, and frankly, if you're not going to be able to deliver them, the grant is not for you. Binary decision, and again, if there's some kind of strange quirky rule in there, for example, we quite commonly see grant schemes where they're supporting capital expenditure, but for some reason capital expenditure which is covered by a lease or a finance agreement is excluded. Now that may again defy logic, but it's just the way the scheme is, and you have to be mindful of it. How do they get from that oversubscription down to the number of of deals that projects they're able to support, they use a process invariably which we describe, or is described on that slide, as relative merit. So they're looking at, I mean, your scheme, your program, your project that you go forward with could tick all the boxes, it could meet all of the requirements of the grant, but it may still lose out because when they judge other projects alongside it, they also tick all the boxes but deliver more outputs. You've no way of knowing that. Clearly the submission is blind, and therefore this can be a frustrating area. I'm not discouraging people, by the way. This is free money, so if you see a grant scheme that you think is suitable, we have a team at Jerroms that can help you with the application. We work with partners on some of the bigger schemes as well, where we can put you in touch with people who are, professional bid writers. EU programs and the B word. I mean, we're still a member of certain EU programs, so certain of the programs, certain of the grant programs are still supported through European funding that we contribute to from the UK, and will therefore still be subject to EU rules on things like state aid and intervention and so forth. The B word, I mean, I have seen emergence literally in the last few months of some post-Brexit grant programs, so you're going to start to see more and more of those coming through with a new set of rules rather than no rules at all. Some sample grants on the next slide, which I'm not going to go through in detail, but the restart grants are clearly designed at companies that have struggled through COVID. Kickstart scheme was launched a little while back, and as is a generous scheme where it allows really quite high levels of funding of apprenticeships and new training jobs. It was subject to a rather bizarre rule that it had to be a minimum of 30 job placements, and at the time we were offering a scheme here at Jerroms where we'd try and link companies together to get to that 30 limit. The good news is that limit is no longer applicable, and they've reduced it down, I believe, to 5, so it's a much more manageable and viable scheme now. And the Help to Grow scheme, again, this is to do with training and upskilling the workforce, but again provides some grant support for that. We do periodically send out a grant update giving you some ideas on the schemes that are available, and anything new comes out that we think is suitable, we will try and get an email bulletin out to you. These are subject to call, so they appear periodically in various publications, which we try and keep an eye to. But if you spot one that we haven't, let us know, and we'll get it more widely circulated. The second form of finance I'm going to cover off is debt, and there are as many forms of debt as there are months of the year, really. I mean, there's a huge number of different flavours, and most of these will be familiar to people that are on the webinar. So you'll have, all I hope and trust, will have come across hire purchase and lease agreements, maybe mortgages, term loans where there's a fixed term agreed for the loan to be repayable. Revolving finance may not be a term that you're familiar with immediately, but it's actually to do with typically invoice discounting and factoring, where you effectively pledge your receivables in return for some in return for the advance of finance. Supply chain finance and supplier finance is far less common, and is the one that recently got our former Prime Minister, Mr. Cameron, into some trouble. But it's out there, and it's a means by which you can effectively secure additional credit from your suppliers, but at the same time offer them a way of drawing the money down more quickly, subject to the payment of finance fees. Payroll finance is offered by a number of payroll providers, so there are some out there that will offer to run your payroll for you, and indeed offer you a month, or in some cases 2 months worth of credit on having to meet that payroll bill. Import finance, fairly self-explanatory. The old Siebels, the near recent Siebels and Siebels loans have came to an end at the end of March, and we now have a replacement under what's known as the Recovery Loan Scheme, which is a lot of similarities. It's a government-backed loan scheme offering, I think it's 75 or 80% government underwritten guarantee, and subject to certain restrictions. I think the loan has to be below 250k. There are no personal guarantees on the non-government guarantee backed element of it. There's lots of local and regional financial offers. Those who haven't heard of it, the Midlands Engine Investment Fund offers a number of debt products, and he's actively seeking investment opportunities. Peer-to-peer and crowdfunding is out there. Many of you will have heard with the likes of Funding Circle and ThinCats. These are opportunities for consumers, individuals, people like ourselves, to take part in a process by which we can lend money to businesses and take maybe a slightly higher return than we would get on our deposits. And the one at the bottom, which is another acronym, is the Community Development Financial Institutions, better known to people like ART, Aston Reinvestment Trust, and BCRS in the West Midlands. And these are organisations that support social enterprises, but also do loans on the smaller end of the spectrum, so where it's more difficult for larger organisations and even banks to support loans. These are organisations that can do that more effectively. I had some flickering there, so I hope I haven't lost any of you. Secure debt. And the types of finance, unsecured debt. Actually, it does look like you've frozen on me. Sharon, can you still hear me? Is there anybody there? Have I logged out?
Yes, it's all okay. You can continue.
Okay, sorry, thank you. Okay, it's all right, my screen's flickering all over the place. So, okay, so I'm just going to touch off on types of debt in terms of secure or unsecured debt. Again, fairly self-explanatory, hopefully, but secured debt is where there's an asset pledged against the debt. The most common form of which you'll all be familiar with is a mortgage, where your property is pledged as security against the loan, but it takes other kinds of forms. So plant and machinery, we touched on earlier, invoice discounting and factoring, and they're effectively pledging your receivables against the debt. Inventory, far less common now, and even less so since the Crown debt preference was reintroduced back in December of last year. So inventory finance is much harder now to find, but there are some options still available, and it is still out there. So they are what they say on the tin. They're secured against an asset. It's not uncommon that either instead of or as well as you'll be asked to offer up a floating charge, which effectively gives the lender security over not just the asset, the fixed asset that's being secured, but also over any other assets of the business. And it isn't uncommon for there to be a bit of both, really, so a belt and braces approach to lending. Unsecured debt is, clearly just the opposite of that, and yet I guess it'll be lost on none of you that up on that list is personal guarantee. How can I be be asked for a personal guarantee and for the lender to regard it as unsecured? Well, the terminology secured relates to an asset that there's something that can be charged against, whereas a personal guarantee is there is no specific asset pledged. Now, I don't play down the significance of this. So, personal guarantees shouldn't be taken lightly. And in most lending situations, that, you know, in the event of a default, then they will come after all of the lenders first. So they'll come after anybody offering up a personal guarantee before, you know, before they, if you like, give up and take a loss, or before they even go back to government and seek the government guarantee. Now, there's a flip side to that. Clearly, why you're being asked to give a personal guarantee, well, I know it's a horrible term, but it is to do with you having some skin in the game, something at risk as well as the lender. But to me, you know, they deal with the risk by pricing it into the rate of interest, but it is what it is. So be aware of the fact that you may be talking to a lender about what they're referring to as an unsecured product. That doesn't necessarily mean they're not going to ask for a personal guarantee. Onto equity, and equity is probably the least well understood of all the various forms of finance. You know, I hesitate to use the analogy, but you know, the Dragon's Den, you'll have seen episodes, hopefully, of the Dragon's Den. You'll see that they're taking an ownership in the a share of ownership of the business in return providing the finance. The good news is that it typically requires no form of security, fixed or floating. And another piece of good news is it's quite rare, not entirely unheard of, but quite rare that the investment needs to be serviced, i.e. repaid. It's there. And to use the great British breakfast analogy, you know, in terms of the chicken was involved but the pig was committed, then it is a form of commitment. They are putting the money in that is going to stay in the business and stay in the business for the whole of the journey. It is a little bit more complex to arrange. There are some documents that need to be navigated through to get to the threshold of securing an equity investment. It's not uncommon that they'll seek some kind of observer rights or non-executive directorship position on the board of the company. In part, that is to do with governance, so they're keeping an eye to make sure that you don't take the equity money raised to grow the business and blow it all on wild women and fast cars and then waste the rest. So they are looking at governance, but the primary purpose is to assist and help the business to grow. Remember, they are committed, they're with you for the long term. It is high risk to the investor, and therefore it won't surprise anybody, I'm sure, to know that the expectation on the part of the investor is going to be that it needs to be capable of delivering a high return. So they will be looking for growth companies, or the current parlance is scale-ups. So they will be looking for businesses that can scale and scale rapidly. And of course, because they're taking an ownership of the company, they'll be looking for businesses that have an intention to exit. So if your plan is to hand your business on to your children and your children's children, then you're probably not a candidate for equity. You know, it is about growing the business with a view to eventually selling it. I did promise you all that I'd mention mezzanine. Mezzanine, almost as the name implies, really is a hybrid of two different types of finance. It's effectively a debt product that is priced to deal with equity type risk. It works particularly well in family owned businesses. It works particularly well where there's two 50-50 owners of a business, and no equity investor really wants to find themselves in the position of having to referee between two founders should they ever fall out. There's a number of ways that mezzanine providers can, if you like, price their risk in. They can take an equity option, which is often referred to as a kicker, where they don't actually take a percentage ownership of the business until the day before or seconds before the business actually sells, which is in reality the only time equity has any meaning to them anyway, when the business is about to sell. They can use a redemption premium. We've done a couple of deals where businesses agree to pay some of the risk, if you like, in the product at redemption if the loan goes to term. More rarely they're used in early stage equity, and I could spend a little while explaining why, but it's to do with the equity conversion rights. It's interesting to see that the government themselves have been using this recently. The Future Fund Scheme that some of you may have heard of is a convertible loan note that the government will invest in a business. And I'm not predicting this. I don't want to be the kind of prophet of positivity or gloom. But either way you look at it, it does show that the government is sighted on this issue, and maybe we'll see more of this type of intervention rather than pure grant support as we kind of emerge from the umbrella of Europe. There aren't that many providers of it. It is growing. It's becoming more popular. We happen to be blessed with a couple in Birmingham, which is quite unique, given that there aren't that many UK wide. It is an interesting form of finance and can work well in some circumstances. But again, I can take questions at the end on Mez if anybody's interested in that. So what typically are the providers of these types of finance looking for? It's interesting to just take the perspective on that for a minute and stand back. So grants, there will be a theme to the scheme. That's not easy to say with your teeth in. A theme to the scheme. So they do calls, and the call for applicants to the grant will specify the kind of things they're looking for. So could be an innovation award, it could be something that is linked to the development of intellectual property rights, could be covering early stage research and development. Not uncommonly these days, and thank goodness this is true, I guess, is we're seeing a lot of green, low carbon, environmentally sustainable projects the government is looking to support. As previously mentioned, there will be some output you've got to deliver. It's no good saying, well, I'm applying for a green scheme and that's the end of it. I mean, a green scheme is likely to have some kind of carbon reduction targets, and there is an expectation that the project will at least seek to try and deliver those. But the interesting thing about perspective wise is that really grants are looking for leading edge or bleeding edge projects, high risk. There's an expectation that some of those things, the projects they support, won't be successful. They won't deliver on the promise that they'd hoped for, and in a sense, that's almost entirely why they're grant suitable. Debt, on the other hand, couldn't be a more opposite end of the spectrum. I mean, talk about looking for dull. They're looking for, remember, the things that matter most to debt providers is the ability of the business to service the debt. That's just a fancy way of saying repay it, and that it has, if possible, some form of security underpinning it. They're looking for predictability, reliability, certainty. They're looking for steady. They're looking for low risk. Now, it's not uncommon for us to put together what's known as a blend when we work with clients on raising finance for growth. It's not uncommon for us to look for more than one type of finance to meet the business need. And there you've got a classic example of why you would develop an individual pitch deck. I know Tony talked earlier about preparing the business for finance, but right down to the taster document or the pitch deck is going to be specific to the target, and we are looking specifically here at maybe an entirely different story is being served up to a debt provider, to a grant. Equity fits somewhere in the middle. So yeah, you've got to be able to show high growth and the ability to scale, back to the scale up terminology. They're looking for innovation, and again, they're looking for some form of intellectual property. Again, why? Because fundamentally it protects the business from competitive threat, really. So intellectual property just slows down competitors entering your space, and that isn't a typo. the survey done by the British Venture Capital Association a little while ago now came back with the 3 things that mattered most to equity investors, and they were in turn management, management, and management. And it's the famous old saying that a good management team will make a success even of a poor product, but a poor management team will fail even with a good product. So they will be focused on the management team, who you are, what your experience has been, have you worked in a similar area and environment in the past, is it a rounded team, has it got the key roles already penciled in as opposed to TBA on the plan. So equity probably doesn't strike everybody as being overwhelmingly obvious, but equity probably fits between grant and debt in terms of its appetite for risk. So how to approach them? On the grants, the scheme itself will instruct. It's a statement of the obvious, but do set aside time to complete, because completion of those grant application forms is not easy. Do take care to follow the application instruction. Do observe the word limits. They sometimes seem, banal and illogical, but if it says, you have 500 words to describe the purpose of the project, there's every chance that when that gets put into the documentation that is delivered up to the team that award the grants, if you've got 550 words, the final 50 words on your application will just be truncated and deleted. And if they were the 50 words that were key to your application, you just lost them. So observe word limits. Clearly observe application deadlines. Most grant schemes have no flexibility whatsoever, and if you've missed the deadline, you're out. Simple as. Clearly, outputs must be realistic and achievable. There is a risk of clawback. I don't want to overplay that. It's quite rare, but don't overpromise if just in the hope that it's going to get you through to grant award. Do consider the use clearly of a professional bid writing team. On debt, I think Tony's covered off the credit check issue and most of these requirements anyway. And again, you might want to consider the use of professional help. Equity, this is an area where I recommend that in terms of the approach, this might sound a bit OTT, but in terms of approach to any individual investor, then I would very definitely take the time to take a look at that investor, establish what they are looking for, but also the kind of things they've invested in before, and tailor the pitch to the audience. That shouldn't necessarily be necessary with debt. Obviously, in a sense, it almost is uniquely the case with grants. But in terms of equity, I think it's worth putting the effort in to make sure that your pitch deck is aimed at the specific investor that is being approached. I think Tony's covered off most of the other one. I know it's corny, but it is true that you really do only get one chance to make a good first impression. Your pitch deck and your business plan, they are the things that enable that to happen. For what it's worth, I think that approaching equity without professional advice, I think is ill-advised. But I guess you'd all think I would say that anyway. So things to watch out for in terms of grants. Just watch out for the eligibility criterion. I did see a document doing the rounds. In fact, I responded to it on behalf of the Institute of Chartered Accountants on the rules that will replace state aid post-Brexit. There's a white paper out on that subject. In fact, I think the closing deadline was last week or the week before on responses to that white paper. For what it's worth, if the draft that was circulated becomes the replacement to state aid, then the rules will be a bit more relaxed than they were under the European regulations. But who knows what will come. There will be some rules on when you can commit to spend. So again, be careful of those, because if you commit to spend too soon, that may disqualify that spend from being covered under the grant. I mentioned earlier that some grant schemes have some quirky rules on assets under finance. Again, that should be clear from the grant rules and regulations form. They will be looking at additionality, and additionality is a kind of an economic concept of businesses and or jobs being created are being over and above those that, if you like, exist already, which is why quite commonly retail, for example, is precluded from grant applications. The theory being that, you know, supporting you know, a shoe retailer in one part of the high street is just displacing a shoe retailer somewhere else. So additionality tends to be a complex area. I don't want to go into it in great detail, but we can guide you through that if the needs rule. Claims rules, there's a very often a requirement for you to show in the grant application that you need the money, but the rules of the scheme dictate that you spend it first and then claim it back. Trust me, that illogicality isn't lost on me, but you know, you need to be aware of these rules, and if that is going to be very difficult for you to do, even if you do get the grant, then talk to us, because we may be able to organise bridging finance to cover the spend in order that you claim the grant back. And again, just be mindful of any clawback provisions. So debt, review the terms, particularly on early repayment. Uncommon, but a lot of people don't know that Funding Circle, which is a common source of finance for business loans today, has a all or nothing repayment provision. So you can either carry on paying on the terms of the loan agreed, or you can pay the whole thing off. But there's no provision to allow you to do a partial repayment if you get a kind of windfall, you know, kind of cash receipt. Keep an eye on arrangement fees. Keep an eye on administration and service fees. Quite commonly in the case of invoice discounting or factoring facility, that's actually the single biggest cost. Interest, you know, notwithstanding, it can be more expensive sometimes from an administrative and service perspective. Deed of priority, not something I'm going to ask you to trouble yourself unduly, but there will be a need, often is the need in the case of debt products, for more than one debt provider to agree between the other who gets priority in the hopefully unlikely event of insolvency. If that problem is one that you encounter, a lawyer or ourselves can help guide you through that. Equity, there'll be an investor shareholder agreement, there'll be a new set of articles, there will be what's known as a prohibited activity list, which automatically sounds scary, which is a bunch of things that you're really not supposed to do without the investor's consent. That genuinely is just about, you know, not being able to spend the money on Ferraris and Caribbean holidays. It is not meant to get in the way of the business being able to do the things it normally does. But there will be a list of things that you're not allowed to do without the investor's consent, and in the case of Ferraris and Caribbean holidays, you probably won't get that consent, so it might be better not to ask. There will be some warranties and indemnities. Again, probably don't have time this morning to cover those off, but it will be you promising that the information you've given them is as accurate as it can be, and your best efforts to give them all of the information they need. As Tony's mentioned earlier, there might be a requirement for securing pre-assurance on certain tax breaks. I won't go into those here, but certainly equity investment can attract certain tax breaks to the investor, and in most cases it is viable for us to get pre-clearance on that. Again, there'll be arrangement fees, monitoring fees, and non-exec fees. And when you are viewing equity as a form of finance, it's wise to think of all of those in the round as to determine whether or not that's a finance you want or need, if it's a choice, because sometimes those other forms of finance are just simply not available or not suitable. So that's a roundup of the key types of finance that are available and the things to watch out for. I'll probably run 5 minutes over what I promised Sharon I would, so I think we've got 10 minutes for Q&A. Sharon, can I hand back to you?
Yeah, sure. Thank you to those of you who've submitted questions. I think looking through them, most of them have been covered in the presentation this morning, but there are a few, if I can just pass them by you, Tony and Paul. So the first one is, do you need a working prototype before raising equity?
I mean, strictly speaking, the answer is no to that question, because there are proof of concept funds. So, and they are about assisting in that very early stage. But it would be fair to say that I don't know, probably I'm going to go as high as 99% or 98% of the funds that are out there to support business from an equity perspective will require not just there to be a, if you like, the prototype, but also for there to be some evidence of likely demand, even if that's just a kind of provisional order or a promise of an order subject to. So yeah, I mean, I think the answer is strictly no. We can seek finance which will assist with the development of a prototype, but those funds are few and far between, rare, and a bit like grants, that they're kind of quite hard to reach out to. So if you can do it funded through yourself, family, friends, and maybe grant, get it to post proof of concept, then there's certainly, that opens up a lot more opportunities in terms of equity providers.
Okay, thank you very much. The next question is, can you apply for a recovery loan if you've already had a Siebels or a bounce back loan?
Tone, is that one you want to comment on? No, I think I've lost Tone.
Yes, you can have a recovery loan on top of the B bills and the C bills loan. They are separate documentation, so it's not like previously.
Okay, thank you. And probably just following on from that, the next question was, is a personal guarantee required on a recovery loan scheme?
If it's less than 250,000, they should not seek personal guarantees.
Okay, thank you very much. And that concludes the questions, actually.
Great, brilliant. Thanks everybody for your time this morning. I hope it's been helpful. You've got Tony's contact details on there and mine if there's any additional questions arising. And this is a series of webinars that we're doing. I think I can't remember now. The next one may be on selling a business or buying a business, I'm not sure, but you'll get invites and welcome to on those if you get a chance to join. Thanks everybody.